Okay. I went up to the security guard again and asked them to turn up the temperature. Right? Can you hear me? No? Let me turn up the volume a little bit. So hopefully in a few minutes the room should get a little warmer, right? Monday I can see the excuse, right? The temperature changed suddenly over the weekend. We left the air conditioning on. Wednesday, what's the excuse? It's been 70 degrees for the last 3 days, so I'm getting a little pissed off. I'm not looking at you for the temperature, but I'm getting a little pissed off, so I'm going to send off emails after this class is done in every direction possible saying we need warmer rooms. But of course, you know what that'll mean, right? Monday you're going to come into 95 degree, there's no middle ground here. Right? You can't fight all these fights and win them all. So let's start today's session. Today we're going to start on the numerator, earnings and cash flows. And we're going to start with some very basic stuff. Remember, you have a project to do. Hopefully you've picked a company already. December 14th of this year, you will have to turn in a valuation of your company. Can somebody remind me what your final piece of that project is? What do you have to tell me? You remember? Buy or sell as of December 14th of 2016. The reason I emphasize that is I don't want you valuing the company as of January 1st, 2016, saying if I'd bought in January 1st of 2016, I don't care. You shouldn't either. If valuation is an exercise that is followed up by action, your valuations always have to be as of right now. But we have a problem, right? All the numbers we use come from accounting statements, and accountants don't update numbers every day. In the US, they're updated every quarter, and if you're looking for the full financial statements, it happens once a year. So let's say that you get around to doing your DCF for your company, which you should sooner or later. You want to get some numbers, accounting numbers to put into your valuation, and I'm going to give you some choices and you tell me whether this is what you're going to use in your valuation. You could take the last annual report or 10K or whatever the last annual filing is. What's the problem with doing that? It's going to be for most companies as of December 31st of 2015. You're saying, what could have happened in 10 months? You're going to find out lots can happen in 10 months. So already let's take that off the list. You should not be using the last 10K or annual report because it's old information. You want updated information. Your third quarter numbers are going to come out probably in the next 4 weeks, which is most companies, September 30th is the end of the third quarter. The numbers are going to come out, say, end of October, maybe early November. If you're doing the DCF before that, your last quarter will be the second quarter's numbers, which were through the end of June. Can you multiply those by 4 to come up with some kind of updated number? After all, that's the most recent quarter. What's the problem with multiplying quarterly numbers by 4? There's a lot of seasonality involved, right? So if you're a retail firm, your last quarter looks very different from the rest, and you're going to be surprised, even at non-retail firms, how much seasonality. So don't do that. Don't take the last quarter's numbers, multiply by 4. It's going to be catastrophic in some companies. So I'm kind of leading you towards the answer, right? So we have quarterly numbers, and you want the most updated numbers. One way to get them is to take the last 4 quarters. And to get the last 4 quarters, those are called trailing 12-month numbers, all you need is one 10K and one 10Q. You don't need 4 10Qs. Because if you have the most recent 10K and the most recent 10Q, let's say it's a third quarter 10Q. Here's what you're going to see in the third quarter 10Q. It'll tell you what happened in the third quarter, but it'll also tell you what the numbers were for the first 3 quarters of this year and compare them to the first 3 quarters of last year. Do you see the math problem you have to do? You have the 10K, which is last year. I've given you the first 3 quarters of this year and the first 3 quarters of last year. All you need to do is subtract out the first 3 quarters of last year, and you have your trailing 12-month numbers. If that sounds too complicated, just sit down with the 10K or 10Q. It's going to come out, it's pretty straightforward. There is another option that is okay, but it's a little risky. By October 25th or 30th, you're going to have the first 3 quarters of this year, right? And you'll also have estimates for the last quarter, where many companies are pretty clear about what's, because they already are looking at the tea leaves and saying this is what the last quarter is going to deliver. You can get that forecasted last quarter added to your first 3 quarters and end up with kind of a mix of trailing and forward. But it'll be, you know who this will appeal to? People who think time always has to work in calendar years. Right? So if you want 2016 to be 2016, then in a sense this is the only way to get it. I use trailing 12-month numbers in all my valuations. Okay? There are parts of the world where it's more difficult rather than less difficult to do. We'll talk about that today. There are parts of the statements that don't get updated, even in the US, every quarter. Things like options outstanding, lease commitment. So we'll talk about what to do about the fact that some information gets updated and some doesn't. But use the most updated data that you can find. We're also going to have to confront the question of what exactly did your company make last year as earnings? That's pretty straightforward, right? The income statement says right at the bottom, it says accounting earnings, net income, operating income. If only it were that simple. So I'm going to pose a question that's going to cut to the heart of why accounting earnings cannot be trusted. Remember, in accounting we divide expenses into 3 groups. We have operating expenses, which are expenses that create benefits only in the current year. Classic example, labor, material. You have financial expenses that are expenses associated with the use of debt. And then you have capital expenses, which are expenses that create benefits over many years. You've all been taught accounting the same way, right? Operating, financial, capital expenses. Operating expenses show up in your income statement right below revenues to get to operating income. Financial expenses show up below operating income to get to net income. And where do capital expenses show up? They should be depreciated or amortized over time. They show up in your balance sheet as an asset. Everything has its place. It's so logical. So I'm going to list out some expenditures, and given this very generic definition I gave you, operating versus capital versus financial, I'd like you to tell me whether this expense is a capital expense or an operating expense. How about building a new assembly line for a manufacturing company? Oh, that's obvious, right? You think, this is going to be simple. Of course it's a capital expense. Why? Because it creates benefits over many years, and in fact accountants treat it as a capex. What if you're a pharmaceutical company and you do R&D? R&D, no company does R&D expect to get a benefit this year. If you're lucky, you might get it. It should be a super capex, right? But what do accountants do with R&D? They show it as an operating expense. So we'll have to come back and deal with it, because it means that if you're valuing a technology company or a pharmaceutical company, what you see as operating income is really not operating income. And we'll have to clean up for that. What if you're a consumer product company, Coca-Cola, or a Procter & Gamble? You do a lot of advertising. In fact, advertising is your biggest single expense. Is advertising an operating or a capital expense? It actually plays both roles, right? So when Coke runs an ad, part of it is to get you to buy Coca-Cola right now, but part of it is also to do what? Build up that brand name, that thing in your head that makes you think Coca-Cola for the rest of your life. Hey, you could argue that some advertising expenses are really capital expenses. You'll never see that in an income statement. It's all operating expense. What if you're Accenture? Consulting firm, right? Their biggest asset is human capital. And how do you build your human capital base? Well, you recruit good people, you train them. You could actually argue that recruiting and training expenses for a consulting firm are capital expenses. This is a nightmare. Because what it effectively means that the way accountants measure earnings is completely inconsistent across different sectors. That the PE ratio for Microsoft cannot be compared to the PE ratio for GE because you have different rules driving the two. And in valuation, we cannot wait for accountants to come to their senses and do the right thing. We're going to do it right from the beginning. So we're going to clean up accounting earnings to make them truly earnings. And it's not difficult to do. It basically means that we can make judgment calls that an accountant could never make given the accounting rules as they are today. Final question. One of the things we have to deal with is the fact that we all live in a world where our returns are after taxes. Well, that doesn't mean we don't try to reduce the taxes we pay, and we can try to minimize the taxes, but when we look at cash flows, those cash flows are after taxes. So one of the things we do to get to the cash flows, we take operating income and multiply by 1 minus the tax rate to reflect the taxes. And there are two tax rates you see at play, and we're going to talk about the two in more detail later, but let's see if you can even give me a preemptive strategy on what to do. One tax rate is an effective tax rate, which is the tax rate you will often see reported in the 10K or the annual report. Somebody remind me again how an effective tax rate for a company is computed. What do you do? It's actually, you go to the income statement, it's accrual taxes divided by accrual taxable income, right? You're saying, what's accrual mean? It's not cash taxes divided by cash income. It's in the income statement. It's whatever you state to be your taxes on your taxable income divided by the taxable income. It's an effective tax rate. Basically, it's an average tax rate across all of your accounting income, but it's really an accrual-based tax rate. The average effective tax rate, actually, let me take that back. The weighted average effective tax rate for U.S. companies that pay taxes is about 25%. File that away, right? That's an effective tax rate. For many of your companies, it's going to be 15, 18, 20, 25, 30. We'll talk about why it's different for different companies. There's another tax rate that's at play here. It's called the marginal tax rate. The marginal tax rate comes from the tax code. It has nothing to do with your company. In the U.S., the marginal tax rate on the federal level on income is 35%. So the federal marginal tax rate is 35%. You add state and local taxes. The additional dollar you make in the U.S., you pay about 40% in taxes. So if you look at a U.S. company, you now have two tax rates at play. It could be a 22% effective tax rate or 40% marginal tax rate. Do you think it'll affect your valuation, which one you use? Absolutely. The 22% tax rate is going to give you a much higher value. So I'm going to ask you this question. We'll come back and examine why you might use. If you had to do your valuation today, given that the marginal tax rate is higher and the effective tax rate is lower, I want you to start thinking about which of those tax rates you would use in computing earnings. We've already talked about which one you use to compute levered betas, and we'll come back and talk about after-tax cost of debt. It's always the marginal tax rate in those cases. Why? Because interest saves you taxes in the margin. But I want you to think about tax rates to use in your cash flows. And as I said, just think about it, because during class today, perhaps maybe not this session, maybe the start of the next session, we'll confront that question, because it's going to be a big factor driving the values of the companies that we look at. Okay, so let's go back. I think we were on slide 99. We're talking about the cost of debt. Now, let me restate what I said we're looking for. We're looking for the rate at which you can borrow money long term today. And I said the way you build it up is you can. The easy scenario is if I give you a company that has bonds outstanding, you look up the yield to maturity, and I pointed out the dangers of doing that. Or if you have a rating for your company, you trust the ratings agency and you use that rating to come up with the cost of debt, and you know the dangers of doing that is you're trusting the ratings agency. But in doing all of this, a reminder. Remember I asked you to pick the currency in which you're going to do your valuation early in this process? And you picked US dollars, Brazilian reals, Argentine pesos. The cost of debt has to be estimated in the same currency in which you're doing everything else. The reason I emphasize that is sometimes you might have a Brazilian company that borrows all of its money in US dollars. You can do that, right? Companies can borrow in a different currency. Baidu has almost all of its debt in Europe and the US and other currencies. So when you compute the cost of debt for Baidu, you might be tempted to say it's a Chinese company, but all its debt is in dollars, therefore I'm going to use a dollar cost of debt. You cannot do that. If your cash flows are all going to be in renminbi, your cost of debt has to be in renminbi as well. So let's talk about how to estimate the cost of debt. For those companies, we don't get a helping hand, a yield to maturity on a bond or a rating. You've seen this in corporate finance, but let's look at it again. It's very simply, you're acting like a ratings agency, and I want you to think like a lender. So when you're a lender, what do you think about? You think about protection against not being paid. So you're saying, how much buffer does this company have in making its interest payments? And the bigger the buffer, the safer it is. The ratio that I used in corporate finance and I continue to use in valuation is called the interest coverage ratio. Interest coverage ratio is operating income divided by interest expense. Before you get too caught up in the mechanics of it, think about what I'm measuring. If you have, as Embraer does, 130 million in interest expenses and you have 462 million in operating income, for every dollar in interest expenses you have $3.56 in operating income. As a lender, you want that number to be high or low? The higher it is, the more protection you have. So clearly, ignoring everything else, you would view a firm with higher interest coverage ratios as safer than one with lower interest coverage ratios. With the caveat that income can go up and down. So if you have a company with a high interest coverage ratio but very volatile operating income, you will probably see more default risk in it than if it has less volatile operating income. So this is the way lenders have always thought about how much should I charge for debt. You're going to use that same frame of reference. But to make our estimation easier, we're going to bring in a rating. Why? Because if I have a rating for your company, I can go to the market and observe what people can borrow at that rating, right? So that's called a synthetic rating. And if I can somehow convert Embraer's interest coverage ratio into a rating, then I'm on my way to computing a cost of debt for Embraer. So this is the table that I use for interest coverage ratios. Obviously, the table is set back in 2003 and 2004, which is when I looked at Embraer. And if you look at Embraer, 3.56 interest coverage ratio, yeah, and I use you have two sets of numbers here. One for large market cap companies in the US and Europe, and the second is smaller or riskier companies. So any emerging market company, almost by default, I go to the more risky table. I look up the interest coverage ratio. So if you look up the interest coverage ratio for Embraer, okay, Embraer's interest coverage ratio is 3.56. So the 3.56 interest coverage ratio, the rating I would give them would be BB+. You're saying, what do I do with that rating? In 2004, the spread on that rating would have been 1.5%. Okay? Is that right? I'm sorry, 2%. So if I'm valuing Embraer in 2004, given the synthetic rating I've given them, BB+, the default spread, I would attach them as 2%. You're saying, what are you going to add the default spread to? It depends on what currency I'm doing the valuation in, right? If I'm doing my valuation in US dollars, I'm going to start with the US dollar risk-free rate, and I'm going to add the default spread. So if the risk-free rate is, let's say, 4%, I will add a 2% default spread, and I would say the cost of debt for Embraer is 6%. But if I do that, there's one X factor I'm missing, which is that this is the default spread. I'd give a BB rated US company, right? A developed market company, but Embraer is a Brazilian company, and I'm a little worried that there's this added risk I face as a lender because your company happens to be in the wrong country. So with emerging market companies, I actually have two numbers I add on to my risk-free rate. My risk-free rate was 4.29%. I add the default spread for Embraer, but I also have to incorporate some or all of the default spread for Brazil, which was a very big default spread in 2004. Now, I'll give you the conservative way of viewing this is, you're a Brazilian company, no matter who you are, I'm going to add the entire default spread for Brazil. And remember the three ways we had for estimating the default spread onto the risk-free rate for you. But if you're Embraer and you get 80% of your revenues outside Brazil, is it possible that you could actually borrow at a rate lower than the Brazilian government if you're borrowing in US dollars? Yes. For the longest time, the ratings agencies refused to admit to that. They used to have what was called a rating ceiling for a company. You know what the rating ceiling was? A sovereign rating ceiling? Basically, they said if you're in a single B rated country, I don't care how financially secure you look like as a company, the highest rating you can aspire to have is single B. They started relaxing that about 15 years ago, and I call this the Petrobras rule. The reason they started relaxing it, and this is funny looking at where Petrobras is today, is in the early part of the last decade, Petrobras was able to borrow money from markets at a rate lower than the Brazilian government was. This kind of confronted ratings agencies in the face, saying, hey, you told us there was a sovereign rating ceiling. How come there's a Brazilian company that's able to borrow money at a rate that is lower than the government? So now they actually allow some companies, usually export-oriented companies, larger companies, to kind of get out of the room. What I did was I took 2/3 of the spread. Why 2/3? I actually took 10 export-oriented Brazilian companies in 2004, looked up their cost of debt, looked up the Brazilian government's cost of debt, and it looked like they were able to evade at least some of the country risk because they were getting so much of their revenues in US dollars. So there's a three-part process. I start with the risk-free rate that's defined by the currency I'm doing the valuation in. I add a default spread for the country. Why? It's unfair, but it's because you're a Brazilian company. I'm going to give you a higher cost of debt. Then I add the default spread for the company. The sum of those three numbers is my cost of debt for Embraer. I don't know why the default spread I ended up using was 1%. It was, if I use the smaller, riskier companies, it should be 2%, right? So it looks like I've ended up using A minus and the default spread for the larger companies. So that probably is a mistake. I should have used the riskier companies because I think the spread should be larger for an emerging market company. Yep. I just took 10 Brazilian, large export-oriented Brazilian companies like Petrobras, Vale, Embraer, looked at, because they all had bonds outstanding. Okay? I looked up their default spreads on dollar-denominated bonds. I looked up the default spread for the Brazilian government at that time in dollar-denominated bonds. And across these 10 large companies, it looked like they were carrying only about 2/3 of the Brazilian default spread in their cost of debt. So I kind of worked backwards. If that makes you uncomfortable, remember those lambdas we computed to come up with the cost of equity? You can use that lambda instead, right? That'll allocate a portion of the country default spread into the company. Yes?
You're using country domicile rather than...
Exactly, and that is, I think, the other difference. With equity, I looked at where you did business, and I gave you an escape hatch, saying if you get 95% of it. With default spread, unfortunately, it becomes much more difficult to escape your domicile, because if you fail to pay, guess where I have to go to try to collect from you, right? So in a sense, your country of domicile becomes much more critical simply because my legal rights as a lender go with your... It could change, right? Tata Motors, increasingly, I'm thinking about even breaking this down, because Jaguar Land Rover, when it borrows, is actually able to borrow as if it were a UK company, because for whatever reason, the banker, when you go into a bank, you never mention Tata Motors. You mention Jaguar Land Rover, and all of a sudden your cost of debt keeps dropping. So my suggestion to Tata Motors is they just rename themselves Jaguar Land Rover and see what happens even in the Indian market. Maybe that'll help them. No? So the cost of debt is essentially, in whatever currency you pick, the rate at which you think you can borrow money long term today. Couple of caveats. I use this interest coverage ratio table, which I developed using primarily US companies. Why? Because the way I developed this lookup table is I looked at rated companies. And it used to be, until about 10 years ago, that if you looked at rated companies, 95% of them were in the US. Now it's started to expand more. I looked at rated companies and I made the lookup table based on those rated companies. I'm using this table to come up with synthetic ratings in Peru. I might use it in Saudi Arabia. And you're saying, does it travel? Can you take it to emerging markets? And here's the way I see it. Yeah. It works reasonably well in any market where the level of interest rates is not very different than the US. What's very different? If your risk-free rate in your currency is 3%, 4%, 5%, these spreads seem to work pretty well. If your risk-free rate is 15.5% like it is in Argentina, am I going to underestimate default spreads or overestimate default spreads if I use these default spreads on an Argentine company and I'm doing my valuation in pesos? When you're getting risk-free, you're making 15.5%. I come to you with a safe company, you might not settle for just 1% more. There's a scaling effect depending on... So be careful about taking these default spreads into currencies where the risk-free rate is much higher. We'll talk about what to do about those companies, but it works best if you can stay with a currency close to the US dollar in terms of risk-free rate. So it works great with euros. It works with about half of the developed market currencies. It'll even work with negative risk-free rates. Okay? So that's the advantage. So a little bit of history on these default spreads. Because with every rating there's a default spread. And there's a temptation to say, I have the default spread, I'm going to keep using it over and over and over again. But default spreads can change just like equity risk premiums can change. And in fact, let me take that year where equity risk premiums changed so dramatically, 2008. At the start of 2008, let's pick a rating, triple B, right, investment grade. At the start of 2008, the default spread you'd have charged in a triple B rated bond would have been 2%. So if you're computing the cost of debt for a triple B rated company, at the start of 2008, you're taking the risk-free rate, added 2%. You're done. Let's say it's a US company. As you go through 2008, look at what happens to that default spread. That's a crisis kicking in, right? The same forces driving up equity risk premiums are also driving up the default spread. So by the time I get to January 2009, you're the same company. You still have a triple B rating, but your default spread has gone to 5.75%. You're saying that is absurd. How can that happen? Well, that's what happens in a crisis. Default spreads widen dramatically. Those numbers dropped off in the next few years. The only message I get out of this table is if you have to compute the cost of debt for a company, you want as updated a number as you can for the default spread. I'll send you a link which I use to update the default spreads. It's free. It's the Federal Reserve site has it now. So use it to kind of get an updated spread for any rating. But I think it's important that you update those spreads. Incidentally, those spreads at the start of 2016 were much higher than they were in 2015. I don't know what you want to read into it, but default spreads in 2016 widen across the base. I don't know whether you've been reading what the ECB's been trying to do. That's actually affecting default spreads in Europe. Anybody read those stories? What are they doing now? They're buying corporate bonds. We talked about central banks going insane. This is insanity on steroids. They're buying corporate bonds. To do what? Helicopter money, I guess. Basically dump money, trying to get people to spend more money. So you're saying, so what? Let's play this game out, right? Remember the Greenspan put in what that did to bond markets in 2002 through 2006. You kept lowering spreads, and as you lowered spreads, what did people start doing? They started borrowing more and more money and doing what with it? Buying stuff. Houses, companies, businesses. Until one day somebody woke up and said, the spread is too low, people can default. And says, really? Oh my God, let's adjust all the spreads, which was 2008. You're setting markets up for gigantic letdowns by doing this. You just have to hope that the ECB will be as bad at this as it has been on every other dimension of European crises for the last 10 years. They might manage this just as well as they manage Greece. But if they're efficient at doing this, I worry about the consequences, because you're going to see default spreads drop while equity risk premiums stay high. And that again is a recipe for asking people to borrow way too much money. So let's do one final point about the cost of debt. Let's stay with Embraer. Embraer is a Brazilian company, but it used to be a government-owned company at one point in time, and the Brazilian government still feels it's a company in the national interest. Maybe not as much as Petrobras, but it's up there. And there's a bonus you get because the government feels you're in the national interest. And one of the things that Embraer has had historically had access to is subsidized debt. How does this work? Remember the 9.25% I estimated as the right cost of debt for Embraer given its default risk? Let's say the Brazilian government says, we lend you money at 6% in US dollar terms because we think it's important that we build planes and that makes us part of the global economy. So let's say that's what they're able to borrow money at. They're able to borrow money at 6%. So I have a very practical question. You're sitting down to value Embraer today. You want a cost of capital, right? Which is cost of equity times weight of equity, cost of debt times weight of debt. We've said 9.25% is the rate at which you can borrow at given all this default risk stuff, but you can actually borrow money at 6%. This isn't even a backward-looking number. The government is ready to lend you money right now, long-term at 6%. Should I use the 6% or the 9.25% in my cost of capital calculation? Obviously, it's going to make a big difference. If I use 6%, I'm going to end up with a much lower cost of capital. Which one should I use? How many think I should use the 9.25%? Okay. In fact, if I do the 9.25%, I'm going to come up with a higher cost of capital. I'm going to come up with a lower value. In effect, what am I saying? There's a subsidy, but I'm going to act like it's not there, right? As an investor, do you still benefit from the subsidy? Absolutely. So what you'll be missing if you use the 9.25% is you'll be missing that this company is subsidized. If I use the 6%, I have a different problem. I'll build it into my cost of capital. I'll have a much higher value, and if I'm not careful about adjusting that cost of capital, what am I saying about this subsidy? That it will last forever. And if the government ever says, look, we're in crises, we can't, all of a sudden evaluation. So both ends give you bad answers, right? So you're saying, what the hell do I do? Here's my suggestion. Use the 9.25%, do your valuation. Come up with a value for the company. Can you tell me the value of the subsidy that you're getting? Can you actually value just the subsidy? How would you value it? What would you do?
You said run the valuation at both and the difference.
But there's actually an even easier way. If I just want to isolate the subsidy effect. Take the bond. Take just the bond, right? The bond, take the bond, which I should have paid 9.25% in. I'm paying only 6%. You're getting a 3.25% savings and interest each year. Discounted back to the present, you will get, and you can then decide, I'm going to get the subsidy for the next 10 years and it's over. So you can determine what you think is a fair period for the subsidy, value the subsidy separately, and add it onto your value. Saying, what do I gain by doing it? First, you are getting separation between the value of your company and the subsidy, right? Second, do governments ever do things for you without asking for something in return? In other words, the government comes and says, I'll give you a subsidy. It's like a gift, right? But it's a gift with a kick. You take the gift, and a couple of years later, the government would say, that factory you're building, I think you should put it over there, not there. So, but it'll cost us 20% more. No, I think you should put it there. We gave you the subsidized debt. So subsidies always come with consequences. And what I tell companies is, when you get a subsidy, value the subsidy, but also value the consequences. And 9 times out of 10, you know what you're going to tell the government? Thank you, but no thank you. I mean, I remember valuing a sugar company in India which had a significant subsidy from the government. Right? And in return for the subsidy, they were actually required to sell sugar at prices that were 20% below cost to big chunks. And I said, is this really helping us? He said, of course it is. We're getting a subsidy. And I said, well, let's work out what the cost of that subsidy is. And the cost actually exceeded the benefit. So keep subsidies aside. I'm not saying they don't have value. But they're not freebies, and they don't last forever. And building into the cost of capital, you risk assuming both those things. So we've got a cost of equity using a bottom-up beta, risk-free rate, risk premium. We've got a cost of debt by using a long-term forward-looking rate. We now have one final number we need for the cost of capital. We need weights for debt and equity, right? And if you open up any corporate finance book, any valuation book around the world, you'll be told what those weights should be. Market value weights. And this actually creates some backlash, because if you think about it, we use the market value of equity and debt today. Let's say it's 800 and 200. We get 80 and 20 weights. We put them into the cost of capital. We use that cost of capital to discount cash flows, and we end up with a value of 600 for equity and 200 for debt. You see where I'm going? You started with an equity and a debt value as your weights in the cost of capital, but at the end of the game, you're saying, you know what, I was wrong. It should really be 600 and 200. So I have a question about these market value weights. What's this fixation we have with market value weights? Why do we insist that the weights in a cost of capital, right now at least, should be market value weights? Is it because the market is usually right? If you said yes to that, you've dug a hole for yourself from which you're never going to climb out. And here's why. If you tell me you're using market value weights because they're usually right, at the end of the game, when you tell me your stock is undervalued, you know what I'm going to tell you? Oh, I thought you told me the market's usually right. What makes you right in this particular case? Don't go there. It's not because the market is usually right. Is it because market values are easy to get? As opposed to what? Book values? I can look them up right there on the balance sheet, equity, debt. So it's not because market. Is it because book values of debt are of equity and debt are meaningless? I'd love to say this was the answer because it would feed into my accounting narrative. But you know what? They're as meaningful as any other accounting number, so it can't be that. So what the hell is it? How many of you are working on your CFAs? Anybody here working on your CFAs? Okay. That's like an endurance test, like 7,300 pages. CFA 1, 2, or 3? Which one are you working? 2. Good luck to you. I don't have a CFA. I'm pretty proud of the fact that I don't have a CFA because I can't read 7,300. I'm incapable of remembering that much stuff anymore. But I've been giving the keynote talk at the CFA conference the last 22 years, and every year I start off with the session saying, I don't have a CFA. I'm glad you guys do. But I begged the AIMR, which does the CFA, to let me write the exam 1 year. I said, you know what, just give me the exam 1 year, because I look at the exam. My son second son actually went through the CFA 1, and it's like, standard 50 questions, closed book, lots of mechanical. They're testing you on mechanics and memorization. I said, give me the exam 1 year. It'll be one question. And if people can get the answer, let's give them all 3 levels of the CFA at one go. You ready? I'm going to ask you the question, and I will unofficially grant you all 3 levels of the CFA if you answer this question. Why do we use market value weights for debt and equity and the cost of capital? What is it? What do you think? Well, but the value you're getting is different from the weights you're using in the cost of capital, because you're valuing the company today, but your value is 600. The value used in the cost of capital is 800. So if your rationale is I'm valuing the company today, why not use your own value for the weights? Yep. Book value is not even it's so easy to dump on book value. It can be negative. So could I use it when it's positive? Because you've in a sense given me an opening. So 90% of companies' book value is positive. Is it okay to use book value weights there then? Well, I don't think that's going to hold up. So no CFAs for you. But keep thinking. Yep.
Yeah, I would say that if you go to the markets right now to issue your shares, that's the price.
Exactly. A cost of capital is a transaction cost of capital. Let's play a game. Let's suppose you decide you're going to buy Tesla. Every DCF is a disguised acquisition valuation. It's like you're buying the whole company today. Remind me again, if I decide to buy Tesla today, when I go to the market, can I offer $151, which is my estimated intrinsic value for Tesla? So you know what, my intrinsic value is 151. I could, but how many shares am I going to buy today? 0, because the stock is 206. If I go and acquire Tesla today, it doesn't matter what I think Tesla is worth. It doesn't matter what you think Tesla is worth. I have to pay the price at which the stock is trading at today. And if I try to buy the debt today, I can't buy the debt at the book value. I have to buy it at whatever the estimated market value is going to be, given what interest rate you had on that debt and the default risk you face as a company. A cost of capital is a transaction cost of capital, which means I have to use market value weights. And it bothers people that the numbers don't match, but it's okay, because the intrinsic value is yours to keep. The transaction price, you got to be a price taker. That's why we start with market value weights. So keep that in mind when you think about why we start off at least with market value weights, and why we might then have to change them, and why, if you're doing an acquisition, you actually get a lot more leeway to change the weights, because you then decide how you're going to fund the acquisition. You can have debt ratios that are very different from the existing debt ratio, because you control the levers in the game. So here's what the cost of capital looks like for Embraer. It's kind of the end page we've been working through for all these pages before. It's a US dollar cost of capital. So let me take you through the process. Because it's a US dollar cost of capital, my risk-free rate is the USD bond rate. Okay? To get my cost of equity, I got the bottom-up beta. If you remember the global aerospace company beta, the unlevered, relevered beta, I used a 1.07 levered beta. The risk premium that I was using for mature markets in 2004 was 4%. So I've got a US dollar risk-free rate, a beta for global aerospace companies, a risk premium based on mature markets. But you're saying Embraer is not a mature market company. You're right. So I estimate a lambda, if you remember the lambda that I got. In the case of Embraer, I was able to do that by running a regression of Embraer stock returns against the Brazilian country index and multiplied the lambda by the country risk premium. I use that because in 2004, at least, the only country I was worrying about in the context of Embraer was Brazil. My cost of equity in US dollar terms is 10.7%. To get my cost of debt, I start with the same risk-free rate, 4.29%. I add the default spread for Brazil, and we talked about this just a few minutes ago, plus the default spread for Embraer. I get a 9.29% pre-tax dollar cost of debt. Remember what you said, cost of debt, you have no choice. It has to be the marginal tax rate. The marginal tax rate in Brazil is 34%, so there's my after-tax cost of debt. Market value of equity for Embraer was 11.042 billion. No games, I just multiplied the share price by the number of shares, all classes of shares. So if you have voting shares, non-voting shares, common, so basically bring them all into the mix, 11.042 billion market cap. For the debt, I had a book value of 1,953 million. I was tempted to go with the book value, saying, you know what, I can't really get a market value. But remember we said even if you don't have traded bonds, you can convert book debt to market debt if you have two other numbers. One is the interest expense, 222 million reais, and the second is the average maturity of the debt, 4 years. So what I did was I valued the debt as if it were a bond. So I took the 222 million, treated it as like a coupon payment, discounted back 4 years at 9.29% as an annuity, plus the 1,953 million, which I treated as a face value of the bond, discounted back 4 years at 9.29%. What I get as a present value is not that different from 1.95. I could probably have gotten away with the 1.95. But I now have an estimated market value of 2,083 million. Those are the numbers I use for my weights, which turn out to be 84% equity, 16% debt, and my cost of capital in US dollar terms in 2004 for Embraer is 9.97%. Embedded in there is country risk, the default rate, all the things we worry about are in that number. Any questions on the dollar cost of capital? So let's say you have the dollar cost of capital and you change your mind. Change your mind on what? Remember, you're doing your dollar valuation. That's why you did the dollar cost of capital. You say, well, I've changed my mind. I'm going to do everything in nominal reais. There are two ways you can get a nominal real cost of capital in Embraer. One is to start from the beginning and work all the way through using a risk-free rate in nominal reais. Let's say it was 12%. So everything in this process would be played out with a risk-free rate in reais, a cost of debt in real, cost of equity. That's a lot of work, and you can do a lot of strange things along the way. Like, remember, the default spreads I got were all dollar-based spreads in dollar-based markets. Now with a risk-free rate of 12%, not 4%, I'm using the same default spreads. I could potentially dig a hole for myself. So here's the shortcut I would suggest. I'm at cost of capital in US dollar terms, right? 9.97%. What's the reason currencies matter? Each brings in a different expected inflation rate into the equation. If the inflation rate in US dollars is 2% and the inflation rate in Brazil is 8%, in reais is 8%, I can just take the 9.97% and add 6% if I'm in a hurry, which would give me 15.97%. Or if I want to bring in the compounding effect, which inflation has, I get about a 16.44%. So that extra 0.47% is the compounding effect. The right thing to do is to do the compounding effect, but if you're in a hurry, just add the differential inflation, and you can move from currency to currency. And in fact, when I have to do valuations in troublesome currencies, what are troublesome currencies? Getting a government bond rate is difficult. Or the number I'm getting is a huge number. A Venezuelan bolivar valuation, an Argentine peso valuation. I almost always do my cost of capital in US dollar terms first, and then do the inflation adjustment, because I'm so much less likely to get into trouble along the way. Yes?
So my question actually is the previous slide, but if
Yep.
you have a small company where the only debt that you're trying to convert to a bond market value is like a
Bank loan.
well, like yeah.
Oh, it's different. Revolving credit loans, what's the essence of a revolving credit loan? First, the rate gets reset. It's like having really short-term debt, right? So if I do the market value and I set a 0.5-year maturity, you know what's going to happen? My book value. So the shorter the term of your debt, which can happen either because you have really short-term debt or floating rate debt or revolving credit, then you can use the book value because there's really not much change. It's not that you cannot use the market value equation, but if you did it with a really short t, it's going to converge on book value. It's not going to make enough of a difference. The longer the debt you have, the more you have to worry about converting book value to market value. And the more your company's default risk has changed, the more you have to worry. So it's common sense. So sometimes you can just get away with book value, and sometimes you've got to be a little more nuanced. One final piece of this puzzle. So far in my cost of capital, notice there are only two ingredients. There's debt and there's equity. The world would be a much simpler place, a much better place in my view if you just had debt or equity. But for whatever reason, maybe to confuse us, maybe to throw some smoke into the process, companies create hybrids. What are hybrids? They're part debt, part equity. And the two most common hybrids are convertible debt and preferred stock. You're saying, what part of the convertible debt is a hybrid? The debt part is obviously debt. The conversion is a conversion option into equity. It's really the conversion option is equity. The debt part is debt, right? With convertible debt, my suggestion is a simple one. Break out the conversion option, treat it as equity. And it's actually very easy to do. I'll take you through a simple process for doing it. And take the debt portion and throw it in debt. There goes, your problem goes away. Preferred stock is a pain in the neck. It's a pain in the neck because it doesn't quite fit. If I throw it, because at least in the US, I'm not talking about Latin American preferred stock, which is really common stock without voting rights. So in Latin America, don't treat preferred stock the way you do in the US. Preferred stock in Latin America is just common stock. Treat it like common stock for your market cap. But in the US, preferred stock is more like debt than equity. In what sense? It has a preferred dividend. There's really no upside you get in preferred stock. It's not like the preferred stock is going to zoom through the roof if your company does well. Whereas in Latin America, preferred stock, the dividend is not a fixed dollar value or fixed real value. It actually is a proportion of your earnings. So as you get to do better as a company, your preferred stock will go up as well. So in the US, the preferred dividend is very much like a coupon. It's set at the start and it never changes. Saying, it's perpetual, but you have long-term debt which looks very perpetual too. Just saying, why don't I put it in with debt? What's the problem I'm going to face if I throw it in with debt? I don't get a tax benefit on preferred dividend. I can't subtract out preferred dividends for tax purposes. So if I throw it in with debt and multiply by 1 minus t, I'm going to have a problem. So it's not debt, it's not equity. So bad news. If you have lots of preferred stock, you know what you need to do? Open up a third component in your cost of capital. What's a lot? I have a very, very made up rule of thumb. If it's less than 5%, I cover my eyes, I don't see any preferred stock, and I move on, right? If it's more than 5%, I can cover both my eyes and duck my head under the water. It still doesn't go away. But one of the reasons I don't worry very much about preferred stock is what is the sector that is the biggest issuer of preferred stock in the US? That's convertible preferred. It's all conversion, no preferred. It's actually, I don't even know why they call it convertible preferred. It's really an option with a little bit of preferred hanging in the bottom. But for some reason, they don't like to call it just an option, so they add this little bit of, oh, there's a rump piece that I forgot to tell you about. There's a preferred stock. So it's true, they have a convertible preferred, but really think of it as just equity options in the company. Banks. Why do banks issue preferred stock? It's really a very, very inefficient way of raising capital, if you think about it. Why? Because you pay the rates you would on debt and you don't get a tax advantage. That's kind of silly, right? But what is it that induces banks to issue preferred stock? Because it meets your capital requirements. So when you're doing tier 1, tier 2 capital, so this is a security that was born out of this ugly mating of regulatory capital definitions and bank managers who think that this is a way in which they can get around them. And so the sector where it makes the most difference is the sector where I will never compute a cost of capital. So we'll talk about why you don't have to ever compute a cost of capital for a bank. But if I did do a cost of capital for a company with substantial preferred stock, you have to open up a third component and give it a cost. And the cost of preferred stock is very simple. It's just the preferred dividend yield. You take the dividend, divide by the price today, you're done. There's no more games to play. So that's what you would do with preferred stock. Now let me go back, and I told you with convertible debt to break out the conversion option, and part of it is already going on your option pricing expedition. Don't go there. Don't bring out Black-Scholes and binomial. Value the easier piece of the puzzle. There are two pieces in a convertible bond, right? There's straight debt and there's equity. What's the easier part to value? It's the debt part. So here's all you need to do to value the conversion option. Let's assume you have a convertible bond with a $125 million face value, a 4% coupon rate, and that the market value of the convertible bond is $140 million. So you can observe all three, right? There's a face value, there's a coupon rate, and the market value. Let's assume that this company, when it borrows with regular debt, and you can always look up the rating, and the rating should give you what the regular cost of debt is, would have to pay 8%. You're saying, how the hell are they getting away paying 4%? Well, they've given a conversion option which has pushed up the price of the bond. So here's all I had to do to break out the debt and the equity portions. I took the convertible bond and acted like there was no conversion option. I said, tomorrow if I took away the conversion option, how much would you pay for the bond? The coupons are 4%. The face value is $125 million. You will now discount all of them back at an 8% rate because that's what you would demand. And what you get as a present value is $91.45 million. Where it says 1.0810, that 10 should be a superscript. I'm sorry, that somehow got screwed up. So 91. So that's what you would pay for this convertible bond if the conversion option disappeared. What are you actually paying for the bond? $140 million. Why are you paying 48.85 or 48.55 million more? Because you're getting the conversion option. So here's what I'm going to do. I'm going to take the 48.55, treat it as equity, take the 91.45, treat it as debt. My convertible debt problem just went away. So if you have hybrids, pray and hope you have convertible bonds, because then you can break them out. If you have preferred stock, hope and pray it's less than 5% so you can close your eye and make it go away. But if not, create a third component and you have your cost of capital. So let's review. You've got your cost of equity. For the cost of equity, you've got to go the long route, right? You've got to come up with equity risk premiums reflecting where you do business. Betas that reflect the business you're in. Risk-free rate reflecting the currency you're doing the valuation. For the cost of debt, you start with the same risk-free rate, but you then add a default spread based either on an actual rating or a synthetic rating. And the weights have to be market value weights, at least to start, because that's what you'd have to pay to buy the equity and the debt in this company today. So that's the discount rate part. You're not going to hear me talk about the mechanics of discount rates from this moment on, because I want to move to more interesting territory. I want to talk about cash flows. Okay? And when I talk about cash flows, here's the process by which I wanted to think about cash flows. To get to the cash flows for the firm, let's not even get ambitious and think about the future. I ask you, what was your cash flow last year? You have to start, and it pains me to say this, but I have to say it anyway. You have to start with accounting earnings. You know what that means, right? If your accounting is screwed up, I don't care how good you are at estimating cash flows, your cash flow is going to be screwed up as well. So we're going to spend some time on earnings today, getting earnings right so that our building block is right. The second step in the process, I have to decide how much of these earnings got put back into the business. You're saying, what are you talking about in CapEx and working capital? And why am I putting it back? Because I expect to get future growth. And if I'm looking at cash flows to equity, there's a third layer for me to consider. So I've got to look at earnings, I've got to look at what I'm reinvesting, and I also have to look at how much debt cash flow do I have, how much debt do I have to repay, how much new debt am I taking on. So let's start with cash flows. There are three variations of cash flows you can see in a discounted cash flow model. In the laziest form, you just look at what companies actually pay out. Dividends or dividends plus stock buybacks, because that's what you observe. You say everything else is illusion. I'm going to look at what they actually pay out. That's the old dividend discount model, right? You can try to be a little creative and say, we know companies don't pay out what they can afford to in dividends, and estimate what they could have paid in dividends. That's called the free cash flow to equity. It's cash left over after reinvestment needs, after debt payments, and after taxes. It's whatever cash is left in the till at the end of the year. Or you can estimate cash flows before debt payments. To do that, instead of looking at net income, you look at operating income. You act like you pay taxes on the operating income, and you subtract out reinvestment. You got cash flow to the firm. So you got cash flows to the firm or cash flows to equity. And cash flows to equity can either be your computed free cash flow to equity or actual free cash flow to equity. Now I'm going to take that free cash flow to the firm and show you 3 different ways I will present it to you. So I want to make sure that you don't think it's 3 different numbers. It's actually the same equation presented 3 ways. Here are the 3 ways I can present free cash flow to the firm for you. The full way in which most people write this out is you start with after-tax operating income, EBIT times 1 minus tax rate. You net out what's called net capex, capex minus depreciation. That's what you're reinvesting in long-term assets, and you subtract out change in working capital. So in every valuation book, you'll see this, EBIT times 1 minus T, plus depreciation minus capex minus change in working capital is free cash flow to the firm. Okay. 5 line items to get there, but I'll get there. I could consolidate all these numbers inside the box and call it reinvestment, because that's what it is, right? Net capex and change in working capital is what I'm reinvesting in the firm. It's just a play on words, but that's what I mean when I say reinvestment. It's not just capex, but net capex and change in working capital. Or I can even take that dollar reinvestment and divide it by my after-tax operating income to make it a percentage. So if I have 100 in after-tax operating income and I'm subtracting out 30, then I'm reinvesting 30%. You're saying, why do 3 variations? Because it's good to be able to use all 3, because sometimes one might be a better way of presenting your valuation than another. For instance, when I value young companies, you will never see me talk about capex, depreciation, and change in working capital. You know why? Because I have no idea how they're going to grow. They have no idea how they're going to grow. So I'm just going to say the reinvestment in this company is $30 million. I have no idea what they're going to reinvest in, but they have to reinvest. So if you see me present the 3 value, so go back to this page if you're ever confused about what exactly is he talking about when he talks about reinvestment. It's that consolidated number. Now in all of these calculations, remember what I'm starting with? EBIT times 1 minus the tax rate. So I'm saying if $100 million in operating income, I'm going to act like you pay taxes on that operating income. So let me pause right there. When I do that, I'm acting like you don't get a tax benefit from interest expenses, right? And in fact, when I do free cash flow to the firm, I act like you don't get tax benefits from interest expenses. Isn't that a big shortcoming? I mean, those are real tax benefits. Those are not made up. So how come I'm ignoring the tax benefits from interest expenses in my cash flows? Because when I discount the cash flows, what do I use? I use a cost of capital. What goes into a cost of capital? A cost of equity and a after-tax cost of debt. If I counted the tax benefits from interest expenses in my cash flow, you know what's going to happen? I'm going to double count. First by pushing up my cash flow, and then by pushing. You can't have it both ways. If it's going to be in your cost of capital, you got it. So that's why we don't have. So you can never subtract out actual taxes paid to get to free cash flow to the firm. I've seen people do it, where they'll start with EBIT, and rather than come up with this hypothetical tax you're supposed to, they say, but I actually know what I paid in taxes. You can't do that, because if you do that, you've double counted the tax benefit from interest expenses. So let's start with accounting earnings, right? Because as I said, if you and what I would suggest, if you've already picked a company, this is the week I would suggest you open up the income statement and look at the accounting earnings, the net income, the operating income. Now, I'm going to suggest that any time you value a company, there are at least 3 things you got to do to those accounting earnings to make them usable in a valuation. The first is, when we talked about this, you want the most updated number you can for those accounting earnings. So we'll talk about trailing 12 month and what to do if you can't find the trailing 12 months. So you want updated numbers. You might have to normalize those numbers. You know what I mean by that? If you have an oil company, you're going to see earnings go up and down. And if you have a bad year like 2015 is, you might have to pause and say, should I be normalizing that number? And that's a subjective judgment, because normal is in the eye of the beholder and depends on how many years you go back. But it's a challenge that we're going to have to talk about with commodity companies and cyclical companies. And third, you got to clean up the number. Clean up the number for what? For the accounting misclassifications we talked about. We talked about one at the start of class today, which is things like R&D being treated as operating expenses. And it also includes correction for the other item we talked about in the context of corporate finance, which is when you borrow money and you call it leases, I don't treat it like debt, and I've got to bring that onto the books. So you've got to update, normalize, and clean up. And by the time you're done, the number you're going to have as the earnings for your company could be very different than what you saw in the income statement. So let's start with the updating part. As I said, updating numbers for US companies is trivial. It's trivial because you can go to Bloomberg, pull up the trailing 12-month numbers. You can go to Capital IQ, get the trailing 12-month numbers. But you can do it yourself, 110K and 110Q. Those of you who have ever worked with real companies using data sources, you'll notice that the data sources never seem to agree. You go to Capital IQ, you get one number. You go to Bloomberg, you get a different number. When you're getting different numbers from different sources, what should you do? Go to the source. Go to the actual 10K and 10Q. They're pulling all the numbers. Capital IQ doesn't have some pathway to superior information. They're taking the same information. In fact, they're not even doing it. A computer is feeding in the scraped information that you're seeing. It's being put through some S&P Capital IQ framework that says those items should be counted, those should not, which is fine. But why let them be the intermediaries when you have access to the raw data? So when you're looking at numbers for your company, always start with the annual report, the 10K, the 10Q for your company, and do it yourself, but get the most updated numbers. And here I want to get rid of a problem that some of you might face. Remember I said some numbers will get updated in every quarter, some numbers will not. There's this hobgoblin of consistency that sometimes gets in the way of people doing the right thing. And here's how the logic will go. I can get lease commitments only as of December 31st of each year. I can't update all the numbers. Therefore, to be consistent, I'm going to do all the numbers from December 31st because that's the only date on which I get all the information. That's not the way to think about consistency. When you look at your spreadsheet and look at each input, here's the question you're asking. Is that the most updated value that I can get for that number? And guess what? If it's a risk-free rate, what's your most updated number going to look like? As of the last second. If it's a market price, it's going to be as of the last second. If it's revenues and operating income, it might be as of the last trailing 12 months. If it's leases and options outstanding, it might be as of December 31st. But you are being consistent in using the most updated numbers you can for each input. So update your numbers, and it's getting increasingly easy to do around the world because you're getting full quarterly statements in much of the world. If you cannot, go as far as to make unofficial numbers if you need to, a basis for evaluation. It's better to value based on updated numbers than on dated numbers. Second, let's talk about correcting those accounting problems. There are two big problems, as I said, we have to correct with. First is that financial expenses sometimes creep into the operating expense column, particularly lease expenses. We've got to put them back in the right place. We've got to treat them as debt. So I'll take you through the process of converting leases to debt. And you might have seen this before, you might not have. It's very simple to do. The second is a more tricky problem. In technology firms, pharmaceutical firms, your big capex is being treated as an operating expense. We've got to return it to its normal spot. We've got to treat it as capital expense. So let's start with leases because I think it's the easier half of the equation to correct. How big a problem is it? Depends on the sector your company is in. If you're valuing a retail company or a restaurant, this could be your biggest single operating expense. Take a look down your line items. Your lease expenses or your rental expenses, and US retailers use both those terms interchangeably, could be your biggest single expense. In fact, you can see what percentage it is of total expenses or operating income. In the case of retailers, apparel stores, for instance, it's almost 45% of your operating income. So basically, it's a huge item. And even across the entire market, it's not a negligible item. It's about 10%. The state of accounting as it is now is to treat leases, if they meet that operating lease requirement in the US, as operating expenses. There are some leases that are classified as capital expenses, but what's the accounting criterion for determining whether something is an operating lease or a capital lease? What do they look at? It's ownership. Basically, they look to see whether you have ownership of the asset at the end of the lease period. And if you do, then it's treated as a capital lease. So if you're leasing property, but they look at your lease contract, and based on your lease contract, it looks like you're going to be the effective. So ownership is a 0-1. To me, it's irrelevant whether you own the property or not. If you have a contractual commitment, you have debt. That's the way I see it. A contractual commitment that you got to meet in good times and bad times, to me, is debt. You can dress it up as much as you want, but it is debt. So I've never understood why there's even a debate about this topic. Of course it's debt. And as some of you have been tracking the accounting changes know, in 2018 or 19, at least in theory, it's all going to become debt. Okay. So let's talk about how to convert leases to debt. US companies, if you have operating leases, have to show the operating lease expense in the income statement. But US companies, thank God, are also required in footnotes to tell you what their lease commitments are for the next 5 years and beyond. So you look at any US company and say, lease commitment year 1, year 2, year 3. These are not expected lease payments. These are contractual commitments you've already signed for the next 5 years and beyond. What do we just say about leases? They're really debt. If they were really debt, and these are your expected contractual commitments, what's the value of the debt? It should just be the present value of those commitments discounted back at the pre-tax cost of debt, because these are pre-tax commitments, and what I get as a present value will be the debt value of leases. Let's not talk in abstraction. Let me give you an example. Let's take a company like the Gap, right? Big retail company. This was in 2003. If you looked at their balance sheet and you looked at their debt, there's 1.97 billion debt. You say, that's not bad. It's less than 2 billion debt. It's a big company. But before you decide it has no debt, take a look at the footnotes, because in the footnotes, here's what you'd have seen. The Gap owed $899 million. So these are the expected lease commitments they've already entered into for the next 5 years. And beyond the 5th year, they gave me a lump sum of $1,976 million, because you're not required to break out after year 5. Now, I know they will not have that total payment coming due in year 6. I broke it out into 2 years. You're saying, why 2? Usually what I do is I take the average payment over the first 5 years, and I look to see how many years are in that. So it's as much about common sense than anything else. So if you have $500 million for the next 5 years and $2,500 as your lump sum beyond the 5th year, I think you're in pretty solid ground. Say there's probably 5 years in there. So that then gives me my lease commitments. I discount them all back at the pre-tax cost of debt for the Gap, which was 6%. What I get as a present value of the lease commitments for the next 5 years and beyond is $4.4 billion. $4.4 billion. You're saying, what are you going to do with it? If you ask me how much debt the Gap has outstanding, I'm not going to say $1.97 billion, which is what you see on the balance sheet. I think they really have $6.4 billion in debt. But there is a consequence here. The minute you capitalize leases and treat it as debt, your debt number changes, right? You know what else changes? What do you think of as the operating income for the company? Because the operating income you see for the company reflected the old view of leases as expenses. You now are saying, no, those are not expenses. You've got to add the lease expense back. But don't just stop there, because when I created the $4.4 billion in debt, my balance sheet is this very unpleasant requirement, which is it has to balance. I have to create an asset, right? When I create an asset, what do I have to do with that asset over subsequent periods? I have to depreciate it. You've got to go the distance. You can't just say, this is a capital expense, so I'm going to take it out and leave it there. You've got to go the distance, which means my operating income for the Gap will be the old operating income plus the lease expense minus the depreciation on the leased asset, which makes my operating income become $1.36 billion instead of $1.012 billion. So here's what I'm going to do. This is actually something I did for the Gap in 2004, because accountants have been talking about treating leases as debt since 1949. I'm not kidding. I actually found a panel discussion at the then NYU Business School on whether leases should be treated as debt or how to convert leases in 1949. They're finally going to get around to doing it in 2019. It tells you something about the lag between recognition and action here. But in 2004, there was already this talk, so the GAP said, can you come in and talk to us about what our numbers will look like if we capitalize debt? So here's how I presented the numbers to them. I said, I'll show you what your company looks like from the outside with existing accounting, and I'll show you what it will look like if I capitalize debt. And I'll tell you up front that as I presented this to the GAP managers, they went through various stages of delirium before finally collapsing. So I said, I have some good news for you. Under your existing accounting rules, you look like you made only 1.01 billion, but if I capitalize leases, you made 1.36 billion. This is applause. This is good. This is good. This is good. Keep going. Right? I said, right now in your balance sheet, it looks like you have only 1.97 billion. If I capitalize debt, that's going to be 6.4 billion, and they were a little let down in that. So, but it's good news. And here's why. When I do my cost of capital with existing accounting, because you have very little debt, your cost of capital is only 7.31%. But if I do it with leases treated as debt and have a bigger debt number, at this stage they were hitting the roof, right? Higher income, lower cost of capital, everything is moving in the right direction. Tell us more, tell us more. And I said, here's the bad news. When I computed a return, remember that return on invested capital we compute for companies to see how well or badly you're investing? Right now when I compute that return on capital, I'm using the old debt number, and it looks like you're making a pretty hefty return on capital, almost 13%. But if I capitalize leases, because those leases now become part of my invested capital, it looks like you're making only 9.3%. At this stage, they were completely confused. They said, okay, let's say on the one hand, we have higher income and lower cost of capital. On the other hand, it looks like we're not making as much return on our projects. What's the bottom line? I'm going to ask you to guess, because in a sense, you know what I mean by bottom line, right? If I value the company with conventional accounting, I'm going to have a 7.31% cost of capital, 12.91% return on capital, and all the cash flows coming off that. If I revalue the company with my adjusted numbers, I have a different return on capital, different cost of capital. The question is, am I going to end up with a higher value or a lower value? There's a very simple clue in the numbers I've given you that you can use to answer that question. What's the spread I'm making with conventional accounting? You know what I mean by spread? The way you measure the quality of a company is you look at the difference between the return on capital and the cost of capital. With conventional accounting, it looks like you're making 5.59% more, right? 12.9 minus 7.31%, or 5.69%, 5.59% more. When I capitalize leases, both numbers drop, but the return on capital drops a lot more than the cost of capital. The spread I'm making turns out to be about 3%. At least in the case of the gap, it ended up pushing my value down by 5%. And it's not across the board. When I did this for Target that year, it pushed the value up. You see, what is it measuring? It's essentially treating your stores as the investments they're in, they really are, and what you've invested in them, and saying this company is actually better than it looks and this company is worse than it looks because I've brought the capital onto the books. This isn't a one-sided game where everybody's hurt in the retail sector. It's going to leave winners and losers, and the winners will be the people who open stores in the right places, have kept their commitments down and essentially earned higher returns, and the losers will be the ones who've essentially tied up really expensive store sites for really long time periods and are now stuck with those stores in good times and in bad times. So when you think about leases, that's why we care. It's not because the debt number changes per se. It changes the debt, it changes the return, it changes everything about the company. It changes the story you're telling about the company once you look at the corrected numbers. So that's why we treat leases as debt. And remind me again what it is about the leases that makes them debt. They're contractual commitments that you got to meet in good times and in bad times. You see why I'm bringing that up? Are there other things that companies do that might essentially leave them with this synthetic debt? I don't know whether you remember, Credit Suisse in the late 90s had a superstar banker called Frank Quattrone. He was their rainmaker with the technology sector, the dot-com boom. And he kept threatening. Every year he threatened to leave. Why? He said, if you don't pay me more, I will leave. And they wanted him to stay so much that towards the end of the 90s, They offered him a 5-year contract with a guaranteed payment, I don't know, $30 million a year for the next 5 years, no matter what he did. He didn't even show up. You're saying, what's that got to do with what we're talking about? If I were valuing Credit Suisse in 1999, and I knew you'd entered into this 5-year contract, $30 million a year for the next 5 years, I'm going to treat you like I treat the Yankees right after they signed A-Rod to a 10-year contract. You can tell me how great a third baseman he is, and we can debate that, but that doesn't change the fact that you've now entered into a contractual commitment you've got to meet in good times and bad times. So think of this as the start of a process where you look at a company's expenses and start thinking about how much has this company borrowed, because you can borrow money and never see that show up in the balance sheet if you structure it as something else. Now let's talk about R&D. The rationale for treating R&D as a capital expense is a no-brainer. Creates benefits over many years. And again, how much it matters varies across sectors. Technology, it's huge. You're saying petroleum, they do R&D? They don't call it R&D. In fact, in petroleum, what's the analogous expense to R&D? Exploration costs. They do the same thing with exploration costs that technology firms do with R&D. It's treated as an operating expense. So for these firms, it'll make a big difference. And again, the way you convert R&D from operating to capital expense requires some homework. So let's say you're a firm. You're doing a lot of R&D, and I want to capitalize your R&D. I'm going to come to you with a simple question with a complex answer. The simple question is going to be, on average, how long does it take between the time you do R&D and you see benefits from that R&D? See why I threw the on average up front? Because some of your R&D might not pay off. Some might pay off in 3, 7, 10. Let's say you tell me that it'll take you 5 years on average. Here's what I'm going to do. I'm going to go collect the R&D expenses every year for the last 5 years. And remember, if I'm capitalizing R&D, what's going to happen is I'm going to take that R&D and amortize it over time, right? So if I have a 5-year life, I'm going to be writing off 1/5 each year. And then I keep track of two numbers. Keep track of how much I'd be amortizing this year of past R&D, and I also keep track of how much of the past R&D remains unamortized. Too abstract. So let me use some numbers to illustrate this. Let's assume I'm looking at SAP, a very un-German company. It's an engineering company. It's essentially, it competes with Siemens. With Oracle. It's in the technology space. Very innovative company, very well-run company. It does a lot of R&D. This sector, I'm going to assume a 5-year life. You're saying, what's going to drive that life choice? If you're a pharmaceutical company, it'll probably take you 10 years because you got to go through that FDA process. If you're a typical software company, it might take you 2 years. So here I'm giving 5 years. I got the R&D expenses each year for the last 5 years. That should be easy to get because it's broken out in the income statement. And here's what I did. I took the R&D expense from 5 years ago, which was $745 million. I wrote off the last 1/5 this year because remember, I've been writing it off every year for the last 4 years. I write the last 1/5. It's gone from my books. I take the R&D from 4 years ago, 969. I write off 1/5, but there's still 1/5 left over. R&D from 3 years ago, I write off 1/5. So basically, every year I write off 1/5 of an expense from the previous year, and I look at what's left over. If you add up that last column, you basically come up with $903 million. So basically, add up those 5 numbers, you come up with $903 million. See, what the hell is that? If I'd been capitalizing R&D all the way through, that would have shown up as my amortization expense this year from past R&D. The $2.914 billion is the sum of these numbers right here. That is what will show up in my balance sheet as what I've invested in past R&D that I haven't written off yet. For lack of a better word, let's call it research, R&D asset, or whatever you want to call it. It's now going to show up on my balance sheet as an asset. And remember, balance sheets have to balance, right? So if I show an asset, something has to change on the other side. And I have only 2 places I can put it in. I can put it in with debt, or I could put it in with equity. Where should I put this? Where did all this R&D money come from? It came from earnings that have normally gone to equity investors. So my book value of equity is going to increase by $2.914 billion. My operating income for the company, I have to add back the R&D expense now because I should never have subtracted out. So I add back this year's R&D expense, but I subtract out the depreciation that I've had. So it's a messy process, but it's the same process for every company. So once you do it once, you can repeat this process, which is part of the reason I've automated it in my spreadsheet, where I say, if I ask you, do you want me to capitalize R&D, and you say yes, I do this for you. But essentially, that's what I'm doing in the background. So I'll leave you with a final page. Here's why we capitalize R&D. When I take SAP and I capitalize R&D, my operating income goes up from 1.285 million to 1.359. I'm sorry, 1.285 billion to 1.35. So I get an increase in my operating income. Good news, right? My capex increases by exactly the same amount. So my income goes up by 75, 80 million. My net capex goes up by 75 to 80 million. So guess what happens to my free cash flow? Nothing. And that shouldn't surprise you, because whether I treat R&D as an operating or capital, I spend the money, right? You know why I do this? Because the return on capital that I get for SAP, with the, I didn't work it through, but you can work out the numbers. I think it shows, and you can work it out. The return on capital I get with the old approach, where I don't capitalize R&D, is much, much higher than the return on capital I get once I capitalize R&D. And all I'm saying is, with technology firms and pharmaceutical firms, if you don't capitalize R&D, it's going to look like they're making incredible returns on their projects. You think this is an amazing company, when in fact their returns could be not just bad, but lower than their cost of capital once you capitalize R&D. It gives you a much better perspective. So when we start off next class, we'll start with this page, because we'll talk about what types of companies are going to see the biggest impact of capitalizing R&D.
Oh, I love when you bring the Brazilian focus. When you bring the R&D back to the operating income, why do they doesn't change when you use the capex? Because capex don't have the tax benefits.
That's good, because I show the tax benefit in the operating income.
Yeah, so if you increase the EBIT, you're going to increase the tax you pay.
So basically what I do is I adjust the EBIT to the tax benefit. See the 42 million that I've added to the 1.359 million? That is the tax benefit that I get right now that's coming out of the
So you bring back out.
So there is a tax effect that I've got to reflect, because by allowing you to capital expense R&D, I'm giving you a bigger tax benefit than if I made you amortize you to the same tax. So here, the return on capital.
So return on capital will be lower.
Yeah.
What about cost of capital?
Cost capital
It will be the same. So the valuation.
That's a market equity. Markets.
won't change.
Well, the valuation
Well,
might, because the return on
current-
capital will then affect how much you need to reinvest to get a particular growth rate in the future. It's going to show up when we talk about growth. It will not affect current free cash flow. It won't affect the cost of capital, but it might affect the value of future growth, because the value of future growth is a function of the spread you earn between your return on capital and cost of capital. And that picture can look very different when you capitalize on it.
When a company, let's say, is overhead, and a company is working in Japanese yen. So when you don't have that reference to the US dollar,
It doesn't matter, right? All you need is a spread. Right? So, but if you're borrowing Japanese yen, you can get the spread of the Japanese yen bond, the government bond in Japanese yen.
versus that one.
And then you can use that spread anywhere in the world, right? So you can decide to do the valuation in US dollars. All you have to do is, rather than use the actual cost of the debt in Japanese yen, you take the spread in Japanese yen and you add that onto the USD bond.
Okay.
Because all you need
That
is
is spread. Okay.
so all you need is a default spread. So you can get it from any currency. So that's why I said it doesn't matter which currency you borrowed in, because I can make the choice of whatever currency I want to do the valuation and stuff.
Thank you.
Prof, I have some question about let's say the company that I value, they borrow, they issue like a two currency bond. The first one is they issue in the US, and then the another one they issue like in Thailand, the local currency. And then what should I do about when I find out the cost of capital in terms of the US dollar bond?
That's spread. It doesn't matter what currency they borrow. I mean, you just need a spread in US dollars.
But I would like to value in terms of Thai baht, so I can use the cost of that in terms of the
dollars, and then do the conversion. Remember, all it is that cost of debt plus differential inflation.
okay.
Right? So you can go across currencies easily. All you have to do is remember that the difference will be then you need an inflation rate for Thailand, and an inflation rate in the U.S. is about 1%. So that's given.
Oh, okay.
So all you need is an inflation rate for Thailand. Once you get that,
Yeah.
you can go to the IMF debt predictions. I think Thailand is more like 5.5%. Just
Okay.
take that difference, add it onto US dollar number, you got a Thai baht.
Okay. Then one more is about